Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome you to our open house Q&A session, which is a monthly event that we do live online. We also record this for those who weren't able to make it live. And if you're listening to the recorded session, please understand that obviously you will not be able to ask questions, but you can save them for the next live session and do the same. We are in a very interesting time in the market, and I'm doing my best to get the word out to show people how to manage risk. Because a day like today, Monday the 21st, you can see that the Dow was up 136 points, and it didn't stay that way for most of the day. I'll show you what happened here. On the minute-by-minute chart, we opened up. Again, look at the whole chart. This gray area is the overnight session from last night. We opened higher, but we went a lot higher, came down, and right around 1:15, we hit the low of the day, and then gradually started working higher from there. And what I find most interesting is that on the daily charts, we're still maintaining levels that are lower than the previous trend line. And let me show you what I'm talking about here. We can look at the markets, and I'm using the Dow here right now as the example. We can look at the markets and say, okay, from this low to this low, and if I project out, you can see that was the former trend line. And the reason this line is so important is because once a market or an individual stock or a commodity or a currency, once the price drops down below a very well-established and fairly lengthy trend, it now shifts. The whole dynamic of the market economics, I guess you could say, it shifts because now the market is in a battle to get back up to the trend that it left back here in August. So for as long as we stay below the former trend line, what you need to do as far as strategy is, number one, be very cautious of any new long positions that you take. Number two, if you're able to make any new profits from new positions, I would strongly suggest that you take those profits quickly because they may not last very long. And number three, I would start to look for bear market strategies. Now, please understand, these are my opinions. It's not hard advice that I'm giving. I try to do these for educational purposes so you can see how to manage the risk, more so than actually picking a good stock. You see, I've said it over and over again, and I'll continue to say this for as long as I can, that it's not really how much you make when you're right. I mean, a lot of people are good stock pickers, and those very same people who are really good at picking stocks might be very bad at managing the risk when prices go against them. So you could actually have a 90% accuracy rate in the stocks that you pick and pick the direction correctly. But the 10% of the time when you're wrong, if you hold on to the losses, those very few losses, as I say, as far as percentages, could wind up taking the majority of the money from your account. And that's what I'm trying to do. I'm trying to educate people on how to read the charts so that they could better manage risk and hold on to the profits that they do make when they are profitable or pick a good stock. So there's the trend line, the former trend line. Now watch what happens when I go back to the charts here. This is a daily chart. And this former trend line, which was once support, you can see back here, the stock bounced off of that trend line. What was once support is now that it's broken, is now going to turn into what they call overhead resistance. So those who bought at the top here are now fighting to get back to break even. And believe me, there were a lot of people that bought at the top over here. Going back to the weekly chart, you could see the volume levels here have increased. And right here, some of the people got out, which are these big volume spikes. But for those who are holding on at those very high levels, they're kind of sucking wind right now, saying, you know, I can't wait to get back to break even. Now, by a show of hands, this is the interactive part now. By a show of hands, how many of you have been in a position where you've lost and you have at least suffered unrealized loss, and then you're waiting to get back to break even, and then when you get back to break even, you sell it for what you paid for, and then you feel that sense of relief? How many of you have been in that position? I'll raise my hand too. I've been in that position where you hold on to a loss, and all of a sudden, oh, I finally got out, and you're happy. You're happy you didn't make money because you didn't lose money. You're happy to get out of break even. Well, that's what overhead resistance is really all about. It's when the buyers or former buyers here now become the market's worst enemy because they're constantly battling to sell at break even. And that's one of the most important concepts of the role reversal. That's number one. Number two, as we look at the other more, I guess you could say, broad-based indices like the Russell 2000, you can see that I've left my lines on this chart from last week. If you are not getting the weekly market reports, please just go to the Market Guys website and you'll be able to enroll in the free service. We don't charge for that, by the way, and we'll just mail that to you. It comes every Saturday morning. I actually do the report Friday night after the market closes, and I take my time. I study the markets. I look at volumes. I look at trends. I even look at individual stocks. And then I draw my lines on the chart. I record it, send that to my partner, Bill. He adds the music and all the intros and outros and things to make it look like a very nice piece that it is. And then we send it out. If you're not on our mailing list, then go to Twitter. I'm at the Option Oracle. That's my Twitter, what do you call that, a handle, a name, my Twitter name. And you could pick it up there. But on Twitter, I don't post it until Sunday because I do take some time off with the family. And, you know, we take that time off and we get some downtime so we can understand how important it is for energy Monday morning, like today. And we go ahead and we move through each and every day. So the weekly market report, just for the record, I post that. I make it very public. We have been 100% accurate in the forecast for 2015. 100% of the time, when I said the market was going to move a certain way, it did. And again, for the record, we are recording this. I love to have the evidence because very few people do this. Very few people record and challenge you to go back to check their record. Jim Cramer certainly will not do that, and many other analysts don't do that. They'll tell you on the individual stocks that they like to brag about, but they never come back and say, okay, here's where we were wrong. I make that very public. And right here, what you're looking at are the lines that I drew from last week. And the Russell 2000, again, go back and look at the report that was posted on Saturday. I said that we would go down. I drew this line right here from last week before today. And look what happened today. We have a lower low on a red candle on the Russell 2000. So that's very important that you understand why this is happening as well, because remember what I said about trend lines? Well, once an uptrend has been broken, what is usually the result? Or what generally happens once the bears start to take over? A downtrend starts to form. So I don't want to erase these lines because I'm going to be using these for next week's report to show the evidence again. But what I did is I drew the downward trend line starting from this high, and I connected the highs here, I connected the high here, and I projected down. So now this trend line is going to act as resistance. So if it is, in fact, holding as resistance, I can safely assume that the market will pull back from that line like it has done several times in the past. Now, if I'm wrong and it goes up, well, now we have another shift. At that point, I would feel better, at least, about talking to you about taking long positions. But right now, as long as the price is staying below that trend line, I would rather not see anyone take any new long positions for their own safety. And that's why you have to watch the broad-based indices even more so than the Dow, the spiders, and the Qs. Now, looking at the spiders, SPY, again, I'm kind of going through this, and then we're going to analyze your stocks in a very similar way. You look at the spiders, and again, look at my forecast. This is what I said would happen. I said that we would go down and test this support level. And the support level is taken from this low right here on September 1st. I simply took that low, drew a horizontal line from that support, and I think what could happen is we're going to go down, test that, and then maybe get a bounce. Okay, that's the spiders. And the Qs, QQQ, that's the power shares. So it's more or less the NASDAQ market ETF. You can see the same exact thing happen. I drew my line. Remember, that line was drawn last week. And look what's happening. A lower low. I have to zoom in a little bit closer. You can see that. Let me get my panel out of the way here. Okay. Look at, again, it's so important that you go back and look at the past results. Look at today's low, how it's following my line that I drew before today's action. So that I think that this too will come down. I think the Qs will fill this gap, test the support level, and then maybe get a bounce. Now, don't misinterpret this. On the bounce, or if I'm expecting a bounce, that doesn't mean that I'm thinking, okay, we're back into a bull market. It's clear to go. Everyone should be buying. No, what I'm actually doing is I'm selling into the rallies. And this is an actual trading strategy. Listen, when we're in a bull market, you buy on the dips. And what that means is on the days that you're down, as long as we're still in an upward trend, you buy on the down day after it's pivoted off of a support level. The opposite of that is selling into the rallies after a stock is pulled back from resistance. Here's the NASDAQ. I'm going to take that high, connect it to that high, connect it to that high, and project. Where does it bring me? To this high. So when I see a rally and then I see a pullback from a rally, these are the areas that I'm actually selling into. I might do that on the short side where I make money on the way down, or if I see a pullback in the general market, I might go buy a put if I'm trading the options, or I might buy a contrarian bearish fund that goes up in value when the general market drops. You see, you could still buy things, but make sure you're positioning yourself in the direction of the move, and don't try to fight the trend, because I'm believe it or not, I'm still seeing people trying to take long positions because of the analysts that are talking to them through the television, who could care less about your account, by the way. You see, you have to be your own risk manager here, because none of these analysts are going to call you up and say, Ron, Stuart and Robert and Nathan and Vince and Brenda, it's time to sell. No, they're not going to do that. They could absolutely care less about you. Listen, you may not know me personally, but I really do care about what happens to you. You know why? Because if you're learning this and you learn it well and you become a good risk manager, then chances are you're going to start sharing this information with people you care about. So if I could help you be more or less the ambassador to candle charting and risk management, then we're actually making a difference where the television personalities are just looking to build an audience. We're actually doing something to help people. So that's our mission at the Market Guys, is to basically maintain our position as the world's premier financial educators. That's our goal. Now, I'm going to go back and forth. I'm going to talk about the VIX, but before I do that, I want to show you something here. This is a chart that came out from the Bureau of Labor Statistics, and I've added some notes here to show what this is all about. And these gray areas, hopefully you can see this. Let me see if I could expand this a little bit more. I don't know if I can. All right, let me see. Will that help? No, I don't want to cut the chart out. These gray areas here, if you could look at the table, basically, see shaded areas indicate U.S. recessions. These are the recessions that the U.S. economy has gone through. And you can see that fairly regular in what I would call the cycle. You can see that we're fairly regular in the cycle and that the recessions are spread out. I'm going to quote unquote say pretty evenly, okay? Not exactly in a perfect cycle, but you could see here by more or less extrapolating the data, you could see that we're getting pretty close to what could be another, maybe even severe recession. And here's why I say severe. And believe me, let's try to put our political hats and our political flags in the closet right now so you can understand the economics before you start looking at who might be to blame. Everyone in the world is contributing to market booms or busts. Please understand that the gray area is nothing more than fear, F-E-A-R, fear coming into the consumer market. And when fear comes in, this is how it looks. Nathan might say one day, oh boy, I think a recession's coming, or, oh, I don't like the way the economy is looking right now, so I think I'm going to start banking my cash instead of spending my money. Now think about that. If Nathan talks to his neighbor Stuart, and Stuart talks to Brenda and Vince and Robert and Ron and everyone else, and then all of a sudden Larry is a television personality who is observing this in the behavior of his neighbors, Larry's going to start reporting consumption is down. And guess what? Is it the politicians that could be blamed for the recession? No, not really. It's the consumer no longer willing to spend their money. So businesses suffer. And this cycle repeats over and over and over again. Now, let's throw the political part of this equation into this chart. You can see that this is why they call it Reaganomics. During this recession back here in the early 80s, the labor market actually expanded after that recession. You see this, how it went up? More jobs, more people were coming into the job market. Production was strong. It was very strong, actually. And this is why former President Reagan gets so much credit for what he had done for the country, because like every president, he, yes, suffered through a recession, but it's what happened after the recession that allowed our economy to expand for a good number of years. Then what happened? Crash of 2000, right? Remember the bubble, tech bubble? We had a short recession there, but then look what happened. There wasn't that big of an expansion after the crash of 2000. Then we had another crash in 2008. See, this is the recession back here. But see where I'm circling? See what happened? After the recession, we did not have an expansion of the labor market after that. And that's very dangerous, because look what's happening. If in fact we start to go into another recession, there isn't enough people contributing to the labor force to be able to pull of a recession and get back into spending. Again, understand human behavior. If there aren't jobs for people to make money, then guess what's happening? People are not banking their savings here. They're not spending it. So if we go into another recession, that could be very, very bad. And now let's pull it all together and talk about what the Fed is doing, or I should say what the Fed is not doing. I'm afraid to say the Fed is very on guard right now. They're kind of, well, not kind of, they are absolutely being elusive in their intent to hike rates, because they know that their talk, just Chairwoman Yellen does not want to say, okay, we're definitely hiking and this is how much we're hiking by, because she knows that that'll be the spark that lights the fuse for what could throw us into another recession. Okay, so I know that's a long explanation for what's going on, but this is an extremely important slide that is backed up by data. Again, if you want to do your own research, go to the Bureau of Labor Statistics and you can pull this up yourself. Now you throw that into a big chart. Let's go back to the Russell 2000 and let's look at the cycle here. I'm going to do a monthly chart now. This is a 20-year monthly chart. Look at the Russell 2000. Look, I'm going to take the very low from 2009. Again, that was after the crash of 2008. Take that low, connect it to that low, and I'm going to try to connect to that low, and boom. Look what's happening here, folks. This is very, very serious. And this is what the Fed is looking at. See, Yellen does not want to raise interest rates in such a way that it'll start causing economic tremors. Because look at how close we are to the 20-year support level on a fairly broad-based index. If we start breaking below this 20-year trend line here, watch out below. It'll cause a major downturn in the general markets, and that will throw us into something that could be a lot more severe than what we saw in 2008. Again, look, this was the monthly chart of 2008. It started right here with what? Can anyone tell me what this pattern is? This two-candle pattern. Can anyone tell me what that is? Who wants to do that? Okay. I know there's a little bit of a delay. Who wants to be the first one to identify this pattern right here? Can anyone see that? Yes. All right. Sophie was the first one. Yeah. And Nathan was second. Jeff, Larry, you're all right. Rob, you're all right. That was a bearish engulfing pattern. We had two bearish engulfing patterns at the top that lasted. Now listen, that top back there right up into 2007 took a series of months to form before we crashed. Now again, watch as I zoom in, and again, try to put yourself in the position of Fed Chair Janet Yellen, and look, we have a bearish engulfing pattern here, 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 and the most recent was right here in July, a bearish engulfing pattern. Never before in the history of the Russell 2000 have we had that many bearish engulfing patterns concentrated at what could be one of the most incredible topping formations we've ever seen. That is significant. And I don't mean to scare anyone out, because you shouldn't be scared. See, when you have to keep an eye on this. If you want to take a snapshot of my chart, or go to your own chart and take a snapshot, understand where this level is right here. That's the that level right there. If we break down below, let's put it that low right there. We break down, if the Russell 2000 breaks below, let's say 1100. Let's draw that right there, 1100. We break below that, you could make a lot of money. How? Buy bear funds, buy ETFs, buy gold, buy silver, buy commodity funds that go up when the general market goes down. Because what happens is, investors, and especially the institutional money managers, they have to put their money somewhere. They could not let money sit in accounts right now that have such low interest rates. They're obligated to their investor clients to make the money or put the money to work. So they have to put their money in something that's going to make money. So learn, or at least anticipate, where they're going to start moving the money, and then your trigger point is going to be Russell 2000 below 1100. That's it. Just make sure you're out of your long positions, that you got your watch list ready, and boom, you pull the trigger, and when this thing breaks, you could have the Russell 2000 go from 1100 down to 800. Oh, very easily. And I'm being conservative here, because if you look again back here, the Russell 2000 went from a high of 764 down to a low of 342. It dropped almost 50%, actually 45%. It dropped in 9 months. So why can't we go from 1600 to 800? or I'm sorry, go from 1100 to 800. That's less of a percentage move. So it's very, very probable that that would happen. Again, don't be afraid by this. Be prepared and actually be excited because there's a lot of money to be made. Now, finally, oh, I have to erase these lines because, again, I use this for my charts. I'm only going to erase the lines that I just added now. Okay? And then finally, let me go to the daily chart for the VIX. This is right here. This is the most predictable index that you're going to experience. 2 weeks ago, 3 weeks ago, I talked about this. What is that called? Can anyone tell me? Rob, I know you know it, so don't answer. I know Rob knows it. What is this I'm circling right here? What is that called? Let's see. Yes, thank you, Sophie, Larry, Pascal. It's a gap. Now, the way it stands right now, the VIX, the volatility index, has 0 open gaps. Let me reframe that for you. And there are no gaps that have been left unfilled. 100% of the gaps that have formed on the VIX have now filled. 2 weeks ago, 3 weeks ago, I talked about that ultimately filling. So, and then I said, once that gap fills, there's then an 80% chance that the VIX will reverse and go up. There's the gap. It's filled. It filled here 2 days ago. Now there's a probability, a high probability that the VIX will go up. Why is that important to you? Because the VIX is a contrarian indicator to the S&P. And that means that if the VIX goes up like we expect it to, the S&P will most likely drop. Because remember, it's inversely related, like the seesaw effect. VIX goes up, S&P goes down. VIX goes down, S&P goes up. So we're probably going to go up here. That's why I'm leaving that line in place right there. So that's, I know I took longer than I usually do talking about the markets, but you have to understand why I've been so accurate in having 100% accuracy. To my knowledge, no one in the world has been 100% right, and I would love for them to challenge me on that record, because if they do have 100%, I'd love to see the evidence and what they've been calling. Now, is it possible that I could be wrong next week? Absolutely. I don't expect to stay 100%. I absolutely don't. I don't think anyone in the world can. But while the charts are so accurate, why not just pay close attention to them? Why not pay close attention and make sure you're managing risk accordingly? If you want to learn more about what I've talked about, especially gaps, go to the Market Guy's website, click on the video tab up here, bookmark that, and we continue to build this library. There's a video right here, Trading the Gap. And in last week's report, I talked about how these two videos are running side by side because they do work together. The 1% rule teaches you how to manage risk. Gaps shows you how to get in and how to get out with price targets using the gaps. So pay very close attention to these, and if you've watched them again till you become such an expert in gap trading that you too could maybe one day teach this to the people that you care about most. Okay, now let's do this. We have a good solid 30 minutes to go over your stocks. So if you'd like to submit a stock symbol, go right ahead, and I'm going to take them as they come in. Nathan says M and K. Before we start typing in the symbols, if you could please let me know what your position is in that stock or what your intentions are with regard to that stock. Okay, so Nathan, if you could tell me what your intentions are with M and K, and we're going to look at this. This is obviously a stock that's taken a hit over the course of, let's see, since July 28th, the stock went from 125 to 71. Obviously, the sellers have been in control of that. Now, looking at the left side of the chart, I don't see any support here that would cause me to think that the stock is going to bounce. So what do you think I need to do? I need to get more data. I need to find more time. So I need to take a step back from this chart and just, I'm kind of thinking out loud so you can see how I look at stocks. All right, now I can see where there is support. And what I'm looking for is a role reversal support line. So I see my eye is gravitating to this pattern right here. It's like a zigzag. I want to take some of these highs and try to capture as many of these highs as well as some of these lows. And here is a role reversal support level. So, if you are, Nathan, so you're thinking about, you're long now with some calls. Well, I don't know where you got long, but let me tell you the good news and the bad news. Okay, here's the good news. There's a couple of good signs actually. Number one, we're getting close to a support. That's positive sign, because support, if it holds in a role reversal sort of way, that'll give you a chance to see the stock bounce. Number two, let me zoom in so you can see this. This is a weekly chart now. Look at the volume here. I have to switch my drawing. Look at the volume. The volume is dropping. And I talk about this every single week, whether I'm talking about your individual stocks or I'm talking about the general market. I talk about this all of the time. When a stock is going down and the volume is dropping, that tells us the sellers are slowing down. Remember, the direction of the stock tells you who's in control, but the volume tells you, or it gives you a signal to the force behind the move. So if the sellers are in control and the sellers are weakening, that's bullish. If it were the other way around, where the volume is dropping on the way up, that would tell us the buyers are weakening, which would be bearish. So again, the good news is that the volume is slowing and we're approaching support. Now that I know where that support level is, I can now go back to my daily chart to help Nathan. Today's volume was pretty high. So Nathan, probably didn't make you feel good that the stock was down 10% today. So you have to put your stop somewhere below that support level. I would put a stop to get out of your calls and your stock if it closes below 70. And I know that's still 5% lower from here, but you don't want to be holding on when a major support level like that is breaking down. So be careful. Tomorrow, what you want to see, which would be bullish, is you want to see a drop in the volume. You want to see a drop in the volume here. You want to see a 20, 30, maybe a 40% drop. That'll tell us that the sellers are once again slowing down. I would not buy more to cost average down, would not do that until I see a green candle and a very well-defined pivot point that would be over these highs. So if you want to buy more, I would wait until it gets up to around 85. And I know that sounds crazy to buy it at 85 when you think you could buy it at 74, but you have to wait for the buyers to take back control before you cost average the position. You have to wait for the buyers who are in control. Okay? All right, now UDN. Dennis, I think we took a position in that and we got out at a profit. UDN, I put a recommendation to get out back here when it pulled back from resistance. I think what's going to happen is UDN, by the way, UDN is the bearish ETF for the dollar. I think what's going to happen, I think the dollar is going to rally. And think why. Think about the fundamentals and why that would happen. We took a position in UDN, we got out, we made a little money, but I think the dollar can gain strength, which would be inversely related to UDN. Let me help you here with this for a little bit, Dennis. UUP is the opposite of UDN. So watch, you're going to see something a little different. See, UUP, which works directly with the dollar, had a bullish engulfing pattern on Friday. It's bullish now. So as UUP goes up, UDN is going to go down. They're exact opposite from one another. So I would not go long UDN because short term I'm bullish on the dollar. Now think about why I might be bullish on the dollar. How is interest rates going to affect higher interest rates, that is, which is what the Fed is talking about? How is higher interest rates going to affect the dollar? Higher interest rates is bullish for the dollar, bearish for the stock market, bearish for the bond market, but bullish for the dollar because it attracts people to buy more dollars because they're going to get a higher return on the money. They buy T-bills and whatever else they can get their hands on, they make more money. Remember, money moves into currencies quite dramatically. All right, so be careful that UDN. All right, now let's see, Ron, what is a good entry point on which one? On NAT? Is that right, Ron? What's a good entry point on NAT? I was wondering if you're calling someone Nate there. Let's see, NAT, good entry point. What's going on with my computer here? All right, NAT, there it is. All right, NAT is the Nordic American Tankers Limited. Well, I think, here's what I think. Now, let's, again, I'm going to think out loud for you. Number one, Ron, you're looking to get into this. I like the idea because what's happening? If I take that low, connect it to that, try to connect as many of these lows and project out. Look, I could go here. You might say I could go there, or I can go here and project out, or I can go here. So this is where people get confused. Where do I put that line? Oh my goodness, there's so many different things I can put that line. Just start at the very low and let your eye kind of wander and pick as many of those lows as you can intersect that line to. See? Drop it right there. There we go. There's a couple of things here. This is a cup and handle right here. So we just broke out of a resistance area. That's number one. And we're in an upward trend. So all eyes are on the buy side right now, Ron. I like the fact that you're looking at this. But here's the big but with a capital B. Let me zoom in. What is this right there? Can you see that? Let's everyone participate in that. If you know what that is, tell me. What is that right there? It's a gap, right? Right? Who answered that correctly? Sophie, Sabu, exactly. It's a gap. What happens 80% of the time after a gap fills, like it did on Thursday? 80% of the time it drops, goes the other way, right? That's pretty high percentages. That's number one. Number two, all right, let's see, test takers. What is this candle called? The one that we had today. What is that called? What is that? Come on. Not quite a doji, but close, Nathan. It's close. It's a spinning top. All right, who got that one right? Nathan got that right. Jeff got that right. Pascal, yes, indecision candle. It's a spinning top, Brenda, Nathan. You're absolutely right. Spinning top on lower volume. You see, 1, 2, 3, 4, 5. We have 5 green candles in a row. That's called a stale green light. When you have a stale green light on lower volume, that means expect a pullback. So this is what I expect to happen. Boom, pullback to roll reversal support, boom. That is where your entry point should be. Only on a bounce at that support level. As soon as you get the bounce and you buy in on the green candle, you put your stop right below that. This, by the way, is outlined in my book, The 5 Points for Trading Success. It's identify the trend, identify support, wait for the pivot point, buy on the uptick, put the stop, take action. Those are the 5 points. You got to get in there and see, because if you might say, okay, well, I'm going to buy anyway. I'm going to buy it at 16. All right, then it drops to 15 and a quarter, and then you'll be lucky if it bounces from there. But why put yourself in an immediate pullback situation when you could wait for the pullback and then get on a secondary bounce? That's the way to do it, especially when we're expecting the market to drop. Right? If we see the general market start pulling back, you're going to have the domino effect on a stock like this that's really talking about the tankers out there. Okay, let's go to the next one. let's see, next one, Apple. Phil is long 10 of the $100 January 2016 calls. All right, that means he's long, AAPL. Now be careful. Remember what I said. I spent a half hour talking about how I'm concerned about a pullback. Don't throw yourself in front of a freight train here. Be very careful. Overall, let's analyze Apple. I'm going to get rid of all my lines. Right here. I'm going to get rid of all my lines. And let's imagine, all of us, we do not have a position in Apple. What are we seeing up here? A shoulder, a head, a shoulder. Here's a neckline. Boom. The neckline is broken. This is a topping pattern. We're now in a pullback. Right? Be careful. Be very, very careful. Now, let's take another step back. I'm not trying to talk you out of your position, Phil. I just want you to look what's going on. Look, you had support in the trend line here, connected to here, connected to here, connected to here, and boom. Look what's going on. I can even do this. Zoom into the weekly chart. This is why taking a long position in Apple is dangerous. Bearish engulfing pattern here. Drop in volume here on the way up. This could very well go down. So what am I suggesting for Phil? Now that I see the big picture in the weekly chart, I could then go back and analyze. There is an area of resistance right here from that high to this high. So 117.50 is resistance. I'm not that convinced that Apple is going to go that much higher. Yeah, I see a gap up there. If you're playing that, hopefully you'll get back up and retest this trend line. But you're fighting resistance. Be very, very careful. Phil, I don't know where you bought the January calls, but I would say there's a minor resistance, a minor role reversal. Again, I'm going to erase my lines here so you can see where to manage the risk. Let me zoom in here for you. There's a, can you see this? This is like an inverted V. That's a resistance point right there. Right there. If we go any higher tomorrow, then this former resistance will turn to support. However, if we see a red candle back below that line and it closes 1 or 2 or maybe 3 days below that line, Phil, I would get out. I would just get out and start over again. I would get out. To play it safer, you might want to look at credit call spreads and selling them over resistance points. I have my partner and I are putting together a group option course. We're developing this. We don't have it offered yet, so don't go crazy. We're going to be putting together an 8-week group session for those who can't afford the one-on-one sessions. We're going to put together a group session at a discounted price. You're not going to get the individual one-on-one feel, but at least you'll get an education nonetheless. So we talk about spreads and things like that. So again, caution flag is out on Apple. All right. Jan says, Jan, you gave me 2 stocks, but what's your position? What are you looking at there? If you could help me. And again, if anyone else puts a stock symbol, please let me know what your intention is. Jan, I'll wait for you to tell me that. I'll see if that comes up. Hope you're doing well, Jan. I haven't spoken to you in a while. Let's see. Waiting for Jan. MIC or DK, DNKT. Let me look at those while Jan is answering that. I'm going to look at MIC first. All right, let's see. Ooh, sell it. Okay, next stock. All right, Jan, you're looking for an entry point on MIC. Let's go to basics, real basic stuff. What happened today? Can anyone see? Red candle. Yeah, that's a pretty significant red candle. But look at the drop in that volume. Remember what I said? When stocks are going up and the volume drop, that's a big drop. And by the way, that's at the end of a stale green light. If this stock went any lower, that would be a bearish engulfing pattern. But that is a 75% drop in volume on a higher high but a red candle. So it means that the stock opened higher today, but the sellers controlled it all the way. I probably would not get into that stock until I see a significant bounce off of a major support level. So let's look at the other stock. Maybe I can find something here to help you out. DNKN. DNKN is Dunkin' Brands. Okay. Well, at least this looks a little bit more bullish, but I still would be a cautious buyer. This one looks better than MIC because this is a major gap that has filled. So what happens 80% of the time after a gap fills? It generally goes up. Now here's the quandary. Okay, Jan, pay very close attention. Can anyone see what I'm looking at right here in this section? Look at this. One high connected to another high, connected to another high, and projected out. One low projected to another low. I'm not even going to count this one in here, connected to another low. This is a downward trading channel. It's trying very hard to bounce here, but how far is it going to bounce before it hits resistance? I think upside potential on this is 49.5. You got $1.25 of upside potential before I think it hits and goes down. I think there's better options out there, better choices for you to get long. If you want to get long, look at I'm just throwing this out there, but look at RWX. Is it RWX? No, RVX. Hold on. Look at this. I talked about the volatility index for the S&P, but look at this. This is the volatility index for the Russell 2000. See, gap is filled, long shadows, bouncing off support, next green candle. You could trade these. Jen, I know you're an option trader. You could trade these. You could buy options in these. Where's my, what happened there? I gotta go. Anyway, I don't know where the grid went, but you can trade options on that. I don't know what happened to my option screen. That's crazy. All right, but these are things that you can buy. Look for something that you can buy that will go up if we start breaking down below major support levels and the Fed comes in and starts, striking fear in the heart of every investor that's out there. Okay. Hopefully that helped you, Jan. All right, now, Pam, I'm noticing there's not too many people who are giving me stocks where they're short or in any kind of bearish funds or anything. Pam says GPRO. Is that GoPro? I'm thinking it is. Pam is long GPRO at 32.30. Let's see. Uh-oh. You're right at your entry point. All right. Now, I don't know when you bought it, but here's the good news and the bad news. There's a gap above the market. Is that bullish or bearish? Anyone? A gap above the market. Is that bullish or bearish? Who wants to answer that first? Let's see. Jeff comes in, bullish. Nathan, close second. Nathan, two Nathans. Nathan Bell is second. Nathan is third. Gerard, Jan, Sophie, Brenda, all bullish. That's bullish, yes. Now, where is support? Can anyone tell me where support is? That's a tough one because the only support, excuse me, let me clear that out. The only support that I see is this low. Boom, that's it. And we haven't bounced off of that yet. So we have a minor gap here from today. We have another gap back here from last week and a half, 2 weeks ago. We have another minor gap up here. So that's all bullish. But I need to take a step back to see if there's any more significant. Oh, wow, there's no support on this one. There's really no, oh, that's way back here. I got to go to the monthly chart now to see if there's any pivot points back there. Yeah, the only other major support I have is back from when GoPro came out. And that's down here at around, what, 28.5 level. Okay, now that I found the support level, now I could I'm in better position to help Pam. If you bought it, you want to put a stop below support. Now I'm going to put Pam on guard here. Pam, I'm not trying to embarrass you in any way. I just need to know, where is your stop level? Where's your stop? Did you put one in? Honesty is the best policy. Come on, don't be embarrassed if you don't put one in, because I'm going to help you. Did you put a stop in? Let's see. Pam hasn't answered yet. All right. If you bought it at 32.30, I would put my stop, I would give it $1 lower. That's all I would do, 31.30, and I would be out, a $1 risk per share. And here's why. Limit your loss to $1 using the 1% rule. And if the stock breaks out over this high here, you can get back in. You'd see a bounce, and then you could see even a minor double bottom there. But be very, very careful. And here's why I'm telling Pam to be careful. If the volume was down, I would feel better about it. But guess what's happening? Stock is making another run for lower levels on higher volume. See the volume going up here? See that? So that's telling me that the sellers still have some oomph in it. You know, the sellers are still in control, Pam. So be very, very careful. All right, Pam said not yet, but was thinking below recent low. Yeah, put your stop in. That's like a major thing that a lot of people forget to do, is they'll buy a stock and they use these so-called mental stops. You know, where you, I'll think about it when it becomes too painful, or I'll think about it when my husband starts yelling at me, or my wife starts yelling at me. That's when I'll get out, when it becomes too painful at home. No, that's not a good plan for managing risk. Hard stops, actual stops, options. Those are significant measures that you can take to really trade and manage risk. Okay, TBT. Is that the T-bills, Sophie? When is a good time to go long? Okay, so Sophie's thinking about TBT, and it's the first ultra. Okay, it's ultra short. Okay, here we go. This is an ultra short. This, by the way, is a leveraged instrument that will move. It will move. There's big percentage swings here. You know, look at this from back in, what is that? From August 24th, it had a low of below 42, and went up to 47, 48. Huge percentage swings. Now, looking at the chart, we have lower highs, don't we? 1, 2, 3, lower high, followed by 1, 2 lower lows. This is a broadening pattern, okay? Gap from Friday filled. What's the probability that it's going to go down now after the gap filled? There's an 80% chance it will reverse. That's number one, on the bearish side of the equation. Number two, price has been going up, volume is going down. That's strike two in the bearish column. Strike two, there's two signs here that are telling me we could go lower. Strike three, there's a gap below the market. So I'm expecting this stock to go down, not up. There's three strikes against this one, so I would not even consider buying this one until it comes down to this gap, and then I would consider it if it bounces. That's the only time I would do that one. Okay, plus there's another gap all the way down here, Sophie. Be careful of that one. But here's the thing. It's leveraged. It's a leveraged short. So you could actually lose money on this even if the market went down. Because if the market went down tomorrow and then went back up a little bit the day after, even though you picked the right direction, this could still lose money. It doesn't go exactly in line. It's not conversely related. It's not as inversely related as you think. So be really, really careful of that when you got to trade that technically. Okay, Rob, I'm sorry I don't have Canadian stocks on here. I'm so sorry. The platform just doesn't allow it. So if you have another stock, that's fine. Oh, I have to go to Ben. Oh, here's Ben. One of the few short sellers that I've found here on the chat box. So that's SNE. Ben is short this at 26.75. Now, be careful of this one. Be careful of this one, Ben, because look, this right here has lower highs. See this? I could even go so far as to draw a trading channel doing this. Now, let's look at this more closely. I like your idea. I like it. But yes, Friday, it gapped lower. So here's what I think could happen. I think it could go up to fill the gap, and then I think it could drop from there. That's what I think could happen. So on your side, what I think is most likely going to happen is it's going to test you here. You're short it right at resistance. Right there. You're short it. I would hold this position, but I would have a target get out point for around 23. I would wait for it to come down and test that, because that, although that's the channel line, I think it could very well bounce off of that. So, Ben, short positions are not a long-term strategy. It's like a get in, get out, take my profit, run. And again, you should never get into a short strategy which makes money on the way down for a long-term time perspective. Okay? For those of you who, again, I'm going to wrap up here. For those of you who want to follow me on Twitter, it's The Option Oracle. The Option, it's singular, The Option Oracle, and you put the ampersand there, at The Option Oracle. For Facebook, just search for The Market Guys and stay in touch with me there. I put out a lot of good information. I put out stock information, financial information. It's free. Our videos, remember, our videos on the website are free. Look at trading channels. I just talked about those. Where's the trading channel? Bill, I know it's in there somewhere. Trading channels. That might be on the member side. I have to see. But we have lots of patterns here. Rubber band effect. Learn all about that. And stay excited, because remember, fear, if it takes over, fear will freeze you up in a very negative way. It'll hold you, prevent you from taking your loss when you should, and it'll keep you out of the market when you should be in the market, especially on the right side of the market. So next month, I'm hoping to really get the word out. We're going to really promote next month's session, because as we get into the close of the year, it's going to be very interesting to see what happens as the Fed moves forward, kind of tiptoeing into tightening on interest rates. So that's what we have to look forward to. I want to thank everybody for joining us. Again, this is AJ Monty with The Market Guys. I've been in the markets for 33 years, and it just keeps getting more exciting each and every year. Have a great night, everybody. We'll talk to you soon. Bye-bye.
For almost 3 decades, AJ Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep-it-super-simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with two questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these two questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have two services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for The Market Guys. Thanks for watching.
Enrolling in the service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.